Hey guys, welcome back to the channel McNallie Money, home of all things stock, investment, and personal finance related. Now for today's video, we're going to be welcoming back Fred Thiel, who's the CEO of Marathon Digital Holdings. This is one of the biggest players in the Bitcoin mining space. There's a lot going on. We're going to be discussing their Q3 results and their joint venture expansion strategy moving into next year's halving event. Now, before we get into all that, please take a second, hit the like button, you guys. It's a big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join. And let me know in the comments section below if you're currently holding shares of Marathon, what your thoughts are on their current operations, and your price target for Bitcoin moving into next year's halving event. Now, with that being said, let's get into today's video. Okay guys, so that's right. Today's video, we've got Fred Thiel. He's the chairman and CEO of Marathon Digital Holdings. Fred's been on the channel before, but we wanted to welcome him back to talk about the Q3 results and some of the activity we're seeing in the Bitcoin mining community as a whole. So Fred, thanks so much for being with us today.
Great to be here.
You're always welcome. First things first, for people who maybe missed our initial interview or some of the coverage I've done on Marathon, can you give us just the elevator pitch here, what the company is about and your current operations?
Sure. So we're a large publicly traded Bitcoin miner with operations in North America, UAE, which is United Arab Emirates, and Paraguay. Bulk of our operations today are in North America, Texas, and North Dakota, a little bit in Nebraska. Long-term goal is to be about 50-50 domestic, international on our mining operations. We have a little over 22.6 exahash energized, operational, and running, making us one of the largest miners out there. Very efficient fleet. Typically, across our fleet, we're at about 24 joules a terahash, which industry average is north of 30 somewhere. It's only relevant as you look at the halving because it impacts our cost to mine.
Gotcha.
We also have a part of the business which is focused on technology. So we're the only miner who's vertically integrated on the technology side, everything from the pool software, firmware, down to our investments in ASICs and a company called Auradine, who is a US-based manufacturer of mining equipment. We're also very involved in developing immersion and cooling technology for digital infrastructure. And our whole UAE site is built using some of our early collaborations on that side with partners. And our model is to continue to grow and scale our business. Interestingly, for being one of the largest miners in the world, we have under 60 employees. So we're a very lean shop, have grown primarily through an asset-light model where we partner with folks and are now pivoting more towards an owned and operated model. But that's kind of high level.
That's great. And I know we talked about the FTE or headcount on our previous video as well. I wanted to talk about the UAE site and some of the joint venture activity in a little bit here. I was joking with a friend before the call. You seem to be represented at every single conference. You're traveling all over the world. I don't know how much, I guess a question for you. How much time are you actually at home base there, Fred?
I'm on the road about 3 weeks a month.
Gotcha. Yeah, it's busy and it's becoming a global community, really. So before we get into the joint venture, let's talk about Q3 because you just came out with some really impressive numbers. There's a number of key points in there. What were some of the maybe the top three kind of financial operational highlights in your opinion?
Well, obviously being net income profitable is always a nice thing to be as a miner. Granted, part of that is driven by some one-time benefits from the elimination of debt. We were able to essentially reduce our outstanding debt by over $400 million at a $100 million plus savings. And so you have to take that as income. So that obviously impacts our bottom line. And then we have the usual impairment regarding infrastructure and amortization, depreciation of things that counterbalances that a little bit. But regardless, it was a great quarter. Clearly the benefits of our optimization strategy, getting better uptime, better efficiency out of our miners, dropping our cost to mine, all that clearly had an impact in the quarter. So it was really a breakout quarter for us where you could clearly see the profitability potential of the business longer term. So we're very excited about that. We're now essentially fully energized to what our plan was for the year. And so as we look into next year, we're super excited about kind of further growth going down there and continuing to see the benefits of our investments in our joint venture partnerships, as well as now also some of the investments we're making in alternative fuel sources like methane, landfill gas, and other sources like that. So very exciting year ahead.
Most definitely. I like the word you use, breakout, and we're really seeing a breakout in Bitcoin price itself, the miner stock prices, and a lot of the activity here. The other thing that really caught my attention and must have been welcome news for everyone there is you really received a big in-quarter benefit for your HODL and your massive stack of Bitcoin, proving that thesis of having Bitcoin on the balance sheet really does help companies out. So what is your stance on that? Because we're really starting to see a divergence. Some companies are going to the mine and sell model, very similar to maybe some other resource companies. And then there's others like yourself and Hut who are really holding on to that large Bitcoin reserve. So what's your take on that, Fred?
So we view it as, the Bitcoin we hold on the balance sheet is an investment for us. Just we could be investing in buying miners for that money. But we believe that Bitcoin goes through its cycles, and we acquire that Bitcoin at a somewhat fixed cost, meaning the cost of energy and the cost to mine. And when there is great margin or great profit in that, it's a resource we can use to either spend to cover our operating expenses, which is something we've been doing, and then hodling the rest. And over time, this HODL is going to continue to grow, and we'll likely start using it for making certain investments, because depending on where the price of Bitcoin is at any given day, we're constantly evaluating, is it better for us to sell some Bitcoin to fund buying more miners, or is it better to sell some equity, or is it better to take on debt? Those are the three things we're constantly juggling. And generally speaking, the belief has been that it's better to use equity for growth investments and hodl the Bitcoin. But as we see Bitcoin do another run here, potentially could be time for us to monetize a little bit of our Bitcoin and use that for growth expenses as well. So I think you're going to see a balanced approach to using it as a treasury asset, and we'll have to see. If Bitcoin goes on a big run here, then our balance sheet's only going to get stronger. Today, as of the last public announcement, we had somewhere a little over $500 million in cash and Bitcoin on the balance sheet with $300 million of debt. So very strong balance sheet. Now with the price of Bitcoin where it is today, it's even better. So we feel very confident that we're going to be in a very strong position here as we get into the halving to take advantage of consolidation opportunities, growth opportunities, other things like that.
Great. So I know you talked about the word growth in there a lot, Fred, and you've quoted, I think, 26 exahash by year end. It's just astonishing to see these numbers continue to grow and grow and grow. How do you plan to get to that 26, and what can we expect looking out into next year?
So effectively, as the UAE site gets fully energized, which we're in the process of doing right now, that'll be up and running fully by the end of the year. That gets us to the 26 exahash at that point. If you were to look at our pool stats today, you'll see we're somewhere between 22.5 and 23.5, depends on the day, somewhere in there. And, there's some additional optimization going on across the fleet today, which will give us some additional increases. But with the UAE fully online, our portion of that gets us to 26 exahash. By year end. So we're very excited about that. Then as we look at next year, we've spoken previously about the fact we have about 5 exahash of machines on order, which will be delivered here towards the end of this year, early next year. And we'll begin deploying those here quite quickly in the first half of the year through the halving. And then, we're not going to stop growing. We're going to keep growing beyond that.
Yeah, I've heard the analogy, if you're not growing, you're shrinking in this community. And you talk about the UAE, and I wanted to talk about that joint venture strategy in a little bit more detail. Now, you recently announced another one in Paraguay. We've also seen some really historic election results coming out of Argentina, and South America is really starting to kind of lead the charge there. So how does your strategy in terms of joint venture maybe differ now that we're starting to see that political support down there?
Well, it doesn't change at all. So we use joint ventures as a way to de-risk large international projects. In the UAE, we partnered with the sovereign essentially as a way to ensure that the person providing our power, the person providing the utility grid connection, the person providing the land, all were involved in the transaction. And so by partnering with who we did in UAE, we essentially got all of those things. And so they have a vested interest in the success of the project, which de-risks it substantially. It also allowed us to, for the first time, do a fully built and designed immersion site in one of the most hostile environments there is. You're talking over 115, 120 degrees ambient Fahrenheit or 50 degrees C, huge humidity. And the pilot site that we built there last year ran flawlessly for 100 days before an engineer had to open the door to the container to see if anything was the matter, which was great. And that site has fabulous uptime today, well north of 99% in the current environment right now. And so we're super pleased with that site, very stable, no machine failures. The immersion technology is working really well. And anybody who's curious can go see the videos on our any one of our social channels for the site. As you look at Paraguay, here we're mining off of hydro energy, off a dam. We're partnering with a company that has the local connections, has had already done a lot of the groundwork, if you would, for us. Where the partnership in UAE, we're a minority partner, but we're providing all kind of the intellectual property and the how-to skills. In this case, in Paraguay, we're the majority partner of the deal. And our model going forward will likely be some combination of, in international sites, either we partner with the site developer and essentially buy a portion of the site that we're going to own, operate, and build, or we'll just do a JV for the whole site together with them, where we can bring capital, our know-how, and expertise, a bit similar to how we did in UAE. So those are the international models that work really well because you de-risk, you have local presence, and it allows you to scale very quickly. Again, we're a small organization. We're able to do these things because we have a lot of very smart people, but we have really good partners that we work with. And when you can partner with people, you can scale quickly. You don't have to do everything yourself. And as you look at most miners, we're most probably the most diversified of the miners out there. Right? Most miners are either concentrated to a state or a region. Riot's very strong in Texas. CleanSpark's very strong in Georgia. We're in Texas. We're in North Dakota. We're in UAE. We're now in Paraguay. We're going to continue to grow internationally in different sites. We're doing stuff with methane landfill gas in Utah. We're going to be doing some really exciting stuff with heat recapture, what we call energy harvesting, around leveraging the heat from Bitcoin mining for different applications. Again, all that goes to drive a much lower cost to mine a Bitcoin longer term. And then we're going to do a lot more kind of stuff around climate mitigation and leveraging Bitcoin mining to do some of that. So we're super excited about what we're doing there. And then we also have what we're doing on the technology side. We're built and designed some very strong cooling technology for Bitcoin mining. We're now very focused on taking that to its next generation, which is essentially a dual phase type of technology, which will allow us to deploy that type of technology for people who are in the AI business, people who are in telecoms industry, people who are in the mobile data center business. So that's a business line which has a potential to be very exciting outside of Bitcoin mining even.
Gotcha. Yeah, and that's why I love covering this space. It's rapidly evolving. There's so many new components. It's always changing. I really do like the JV strategy overseas. We're starting to see a lot of this, especially on Twitter or X right now. I'm seeing people posting there's pockets of power or energy that are going to waste, and they're looking for opportunities there. So really cool model. Now the next couple questions here. come from viewers or investors in the company. So we talk about growth. You said it's really managing your HODL strategy, the D word, dilution, which obviously a lot of investors are wary of, taking on debt. So the question is, what is your strategy to finance growth out into 24, 25? And will we see continued dilution?
But going forward, it's essentially going to be a constant focus on what is the most accretive thing for our shareholders, right? Are we going to use Bitcoin? If Bitcoin, you can think of it this way. If we hold, let's say, $100 million worth of Bitcoin, and we think that Bitcoin over the next, 20 months, 24 months rather, is going to double in price, then what do we think of spending that Bitcoin? Should we hold it? Because if we're going to get 100% return on that over 24 months, let's say, what do we think if we sell equity instead? What's the average cost of that capital? Or what's the weighted average cost of using debt to grow? And then you have to balance it. And you want to make sure you have a balance sheet where you're not over levered from a debt perspective. One of the reasons we did our debt buyback was specifically to take advantage of the huge discount that we got in buying back that debt, over 20% discount, and the ability to delever the balance sheet. So we're in a much stronger position, which helps our stock price. While it was dilutive, yes, it takes an overhang off the stock price because, come 2026, that's a large amount of capital that would have to be raised all of a sudden to pay off that debt at par. So going forward, we'll use equity, Bitcoin, cash, combination of all three, maybe some debt, to do things. And it's all going to be based on what do we think is the best use of the asset we're using to fund that growth, right? If we think that Bitcoin is nearing a peak for a period of time and that we're not going to see north of 25% annual return on our Bitcoin holdings, then maybe we start using some of our Bitcoin. If we think that the equity markets are going to be at a certain level going forward, then we may decide not to use equity instead and use Bitcoin because we feel the dilution would be too big. So it's a constant analysis we're doing every time we make a decision. But at the end of the day, it's all about shareholder value and growing the value of the enterprise. The thing about this business, as you kind of said earlier, it's you have to constantly be growing. Global hash rate has doubled essentially this year. If we hadn't been growing, we would have been going backwards. You can look at Core Scientific. They're stuck in this bankruptcy. They haven't been able to grow. Their production numbers are decreasing every month. And it gets harder and harder to catch up if you've been going backwards in this business. So
for sure,
it is a business where you have to keep growing. And, it's like many tech businesses. And, I'm not going to say that we're like Amazon necessarily, but it took Amazon many years before they stopped diluting their shareholders to grow. And today they're this huge, massively profitable company. So.
Yeah, I appreciate you taking that question and the explanation. And I really encourage people to think about that. You've got various different levers at your disposal, and it's just determining which one to pull at which time. And a lot of people, especially retail, I feel really beat up on companies for dilution. But if you're effectively using that money or that as an investment, I think there's no problem there. I will say, Fred, you've got a very passionate following from the retail community. Marathon investors are beating the drum about Marathon everywhere I look on the billboards. Now the next question, again from a subscriber here, talks about retail investors actually as well, and this is more of kind of a sector-wide question, I suppose, but do you have any concerns about the relatively low percent institutional ownership in the Bitcoin mining community compared to the retail investor? And I know this is timely as we're seeing the ETF evolve and more institutions look at this space, but any concerns there?
No, the latest 13F filings we looked at, we were just over 50% institutional. So we've been hovering around 40%. So, 50% is a good, healthy number. 60% would be ideal. You got to realize a lot of the institutional holders tend to be index funds. So it's not that it's not managed institutional. It's, Russell 2000 index, things like that, companies, investment funds that invest using the Russell 2000 have to buy whatever's in the index, and we happen to be in the index. But regardless, that tends to be longer term money than retail. But we have an equity that is very attractive in the capital markets. We have a lot of liquidity. We could trade 20 to 50 million shares in a day. We are an optionable security. People can write options on our security. We have this big pile of Bitcoin, and we have this great beta to Bitcoin price. Bitcoin moves up 1 or 2%, we move up 2 or 3%. Bitcoin moves down 2 or 3%, we move down 5 or 6%. There's this great beta, and so the traders love it. So there's a retail trading that goes on all the time around our stock. You have institutional hedge funds that are in and out of the stock on a regular basis who are trading. So there's added volatility, and the Bitcoin mining stocks are all traded that way. The big 4 or 5 people trade Riot, Marathon, CleanSpark, etc., all kind of against each other, and so there's a lot of trading going on in the marketplace around our equity in that sense. But being so liquid, it's very attractive for that, and that's why it attracts a lot of shorts. So you tend to find a lot of short interest in the stock because there's good volatility, there's good movement. It's great from a day trading perspective. And I think that's just the nature of the beast. So over time, we'll see more and more institutional come into it. With the ETF, what's interesting with the ETF is you're essentially investing in spot Bitcoin. And while you could say, okay, I have 3 choices. I can invest in an ETF, which is spot Bitcoin, and then I'm only going to get the volatility of Bitcoin. I could invest in MicroStrategy, and I can get a leveraged balance sheet approach to an ETF, right? And Michael Saylor just announced again, or MicroStrategy just announced again that they bought even more Bitcoin at this new high price range, and he'll continue to accumulate a lot of Bitcoin because of that. But the benefit you have in investing in a miner is the miner's cost to produce a Bitcoin is essentially relatively fixed, meaning if it's energy and global hash rate kind of drive it. And, if Bitcoin price zooms up to 60,000, miners' margins all of a sudden go through the roof. Well, that profitability will be instantly reflected likely in stock price appreciation. And so when that happens, the beta to Bitcoin price becomes huge. And so that's where the miners are a more attractive investment for certain institutional investors, is because of that beta, right? If Bitcoin price goes for a tear, the miners, like risk-on assets generally in a risk-on environment, will tend to go up. Tech stocks typically their multiples go from, low teens to high 30s as the risk profile shifts. And it's not that their business model changed at all. It's simply risk appetite changes and people go more into growth mode. So I think if we go into an environment where the markets are more focused on growth and Bitcoin goes for a tear, I think you're going to see the whole mining sector do very well. And institutions will continue to invest in that because of that. You could double your money in Bitcoin, but you could potentially do better than that with mining stocks.
Well, let's hope that thesis comes true. And what's nice is we really did, like you see, say Bitcoin miners are kind of a levered play on Bitcoin. There was definitely correlation for a long time, and then it started to kind of see some divergence over the last few months. And it seems the miners have kind of caught up now over the last couple weeks. Bitcoin has kind of hovered flat, but the miners are catching up a bit, which is really nice. Now, the last question I had for you, Fred, has to do with halving, specifically global hash rate. So we've seen global hash rate continue to hit all-time highs. I think as people are just trying to squeeze all the juice out of these machines they can. Come halving, obviously efficiency becomes critically important. A lot of these old machines likely will be unplugged. I've heard estimates anywhere from 20-30% in global hash rate. What are your thoughts there? And do you feel like your fleet is ready for halving and will be ready post-halving?
So in reverse order, I think we're definitely prepared for post-halving. The energy efficiency of our fleet is 24 joules a terahash, where the average is north of 30. So in this business, you want to be in the lowest 25% from a cost perspective. If your cost to mine is in the lowest 25%, you'll always be mining. It's just the way it'll go. if you look at some different scenarios of what could happen here, it's really going to be driven by the price of Bitcoin, right? If we go into the halving in late April and Bitcoin is somewhere between 40 to 50, which is where a lot of analysts seem to think the number is, then you're talking about essentially a global hash rate going into that's going to be approaching 550, almost 600 exahash, which is, well over double what it was at the beginning of this year. So there are going to be a lot of miners who are going to be questionable in their profitability at that point, who don't have very efficient fleets. So that's going to be critical. Now, the next question is then, how long does it take before Bitcoin goes from 45 to 60? Because when it hits 60, all of a sudden, those people are mining profitably again. So some people may just say, you know what, damn the torpedoes, I'll take the loss for a while. Some people have power purchase agreements where, they have to either pay for the energy. They can't just unplug miners, right? They're on the hook for the money anyway. So it comes down to a decision of, do I go out of business or do I take a loss? And that's why you have to start looking at people's balance sheets. Again, we're in a position going into the halving here where we have a ton of cash and Bitcoin on the balance sheet. We're in a very strong position. It doesn't cost us, de minimis what it costs us to service our debt. At this point, we only pay 1% interest on the balance. There's no amortization. So we're in a very good position. Most of our CapEx is already paid for. We're, ready to go. We can be in harvest mode if that's what the market wants us to do. But we can also be in consolidate and aggressively accumulate mode and drive growth if the opportunities arise. So I think we're very well positioned. I think other miners aren't as well positioned. They either have large CapEx commitments ahead of them, or they have had difficulty raising money, and they're trying to raise money now while they can before the economics of the business make it harder for them to raise money post-halving. So we think it's going to be a very interesting marketplace next year. As typical for Marathon, we're agile, we're ready to go in whatever direction the marketplace provides opportunities.
For sure. Yeah, Marathon is one I personally hold, and your scale and size is really beneficial, I think, going into this halving. So, Fred, as always, super insightful conversation. I appreciate your time. I know you're a busy guy. I'm glad I caught you in one of the in-office days. Thanks so much for stopping by, and I'll kick it back to you for any closing thoughts.
Great. Thank you. Really appreciate it, and appreciate the support of all your viewers and listeners. We love being able to talk with members of the community, and people like you do a great job of spreading the story and helping people understand what mining is all about. So thank you.
Appreciate it. We'll talk soon.